I hope you're doing well. It's been a little while since I did a question and answers session, so I'm going to go through some questions that I've received from emails, maybe a comment, and maybe even a response to comment, but mostly emails that I've gotten. Some of these things are things that you might be thinking about, and you're wondering, well, what does Mark think? So here we go. So first, how do you calculate the numbers for the results of the easy plan? So when I put out the free monthly post, I go through and I say, oh, yeah, if you follow this plan, here's the best you could do, here's the worst you could do, and here's on average. So for the worst results, I took the worst outcome you can get with the worst decisions and worst timing. And for the best results, I took the best outcome you can get with the best decisions and best timing. So for the worst outcome, the worst you could do by listening to what I say is you bought at roughly $93,000 at the end of February as the market went down. But that's it. You didn't keep buying down. You just bought that. That was it. And then you sold according to the formula I provided on the rally up to $112,000 for an average of roughly $91,000. Now those are round numbers to simplify the math, but it's a 2% loss. That's the worst you could do. The best outcome you can get, you bought everything at roughly $5,400 in 2020, and you sold at the highest prices of my sell alerts while buying at the lowest prices of my buy alerts, which allowed you to compound your gains. And the result was more than 50x. That's more than 5,000% less fees and taxes because you have to consider the costs. So when you average out the decisions across the full length, you get an average cost basis of roughly $34,000. That's buying high, buying low, sell. And, well, no, you don't include selling. That's too complicated. But at an average cost basis of roughly $34,000, the price today is more than 200% higher, so that becomes the average. And I stick to round numbers because they're easier to remember and they're better for the narrative flow of the content I produce. You got to keep in mind though, those outcomes do not include opportunity costs. So for example, if you sat on $100 or if you just spent it on something else, instead of buying more Bitcoin at $30,000 with two years ago, 3 years ago, whatever it is, you lost $400 as an opportunity cost, meaning you could have put $100 in the market and now it's worth $400. But on that standard, my plan, every plan, no matter what you do, you're losing money. You untold fortunes you've lost, but it's impossible to control these things. And nobody calculates gains and losses on those basis. That's why they call it an opportunity cost. It's not an actual cost. It's just there was an opportunity. You didn't take that opportunity. I didn't take that opportunity, and these are the consequences. But we stick to things we can quantify. At the end of the day, results will vary from one person to the next, and the numbers are really just a reference so that you don't think when you look at this, you think, oh, I'm going to get rich, or oh, this is a terrible plan, and you lose all your money. It is what it is. It's a plan. So the next question, is the 4-year cycle over? It depends on what version you're talking about. In the classic version made popular by Bob Lucas, we won't know until the end of 2026. That version says the bottoms come every 4 years and the tops can come anytime in between. But if you're talking about the idea of a market that peaks in the fourth quarter of every fourth year, well, we still have another 5 months to go before we can say that. And I don't see any reason Bitcoin's price can't reach $113,000 in October, November, or December, or even sooner. So I'd keep an open mind about that, about other cycle theories and data models. I published a report. You can get that in the link in the summary that goes along with this video. And you can read through and you can see exactly what I think about all of these data models and cycle theories. The next question, should I borrow against my Bitcoin? Let's be clear. We're talking about borrowing as opposed to selling or just borrowing. And however you look at it. But we're going to assume we're talking about borrowing as opposed to selling. And it's a matter of preference. It's a matter of circumstances. I wholeheartedly encourage you to borrow against your holdings when the market is down and depressed, and everybody agrees it's a bear market. When they talk about this as a bear market, that's when you think about borrowing. It reduces your risk of default. It gives you a great chance to buy more at great prices. But it's not a simple decision. And so I'll walk you through a comparison. So for example, assume you have one Bitcoin. You bought it at $50,000. It's now at $100,000. You borrow $50,000 and put that money into a money market fund at 4% while waiting for Bitcoin's price to fall or just doing nothing. We know Bitcoin's price will drop to somewhere in the 50s at some point. So let's say that happens in December 2026. You buy another Bitcoin. Now you have proceeds, you can buy another Bitcoin, a full another Bitcoin. So you end up with 2.04 Bitcoins, no taxes, $50,000 worth of debt, plus whatever interest and costs that come along with it. And you have a blended cost basis of $50,000. If that doesn't make sense to you, don't borrow anything. You probably don't want to borrow at all. Don't take any leverage. Don't worry about it. But if it makes sense to you, let's compare that to what The other option would be, which is selling one Bitcoin for $100,000. And then you have a gain that you're taxed on at $50,000. You bought it $50,000, you sold $100,000. Now you have a capital gains of $50,000, and that'll be taxed at whatever it is. It could be 0 to 20% or 35% in the US. I don't know what it is where you are. But the point is, you set aside the money for taxes, you put the proceeds into a money market fund while you wait for Bitcoin's price to fall. So you're getting, so at some point you have to pay your taxes. You get $4,000 worth of interest payments over the course of a year if you do like a US money market fund, just a basic vanilla money market fund. So that's $4,000 of interest payments to cover your tax bill. So if you owe $10,000 in taxes, now you only owe $6,000 because you're taking the interest from the savings and applying that to your taxes. And then you have to consider the taxes on the interest. That's why I say it's not that easy. But the point is, you have this money, $100,000, less whatever the taxes are. Bitcoin's price drops to $50,000 in December 2026, so you buy more, and you end up with 1.9 Bitcoin, no debt, no taxes, and a blended cost basis of $50,000. So who got the better deal? And it's impossible to say, because the borrower got 0.14 more Bitcoins than the seller, but still owes $50,000 to pay off the debt. And that 0.14 Bitcoins, essentially, when you think about it that way, it costs $50,000. And it's a leverage position that they need to pay off, or they risk losing it. Meanwhile, the seller has less Bitcoin, but that person can post tokens as collateral, those Bitcoins as collateral for another $50,000 and buy an extra Bitcoin. So I don't know. You have to decide what's better for you. The borrower has less equity to draw from and may not find anybody to refinance the loan, but there are benefits that come with doing it that way. So, and even that comparison, it depends on the individual circumstances, taxes, cash flow, banking relationships, and all sorts of variables that make these decisions very personal. Another example of how two people can do the same thing at the same time and get different results. Next question, what is the chance that the top is in? I'll put it at 50-50, simply because this market has a habit of catching these crazy pumps out of nowhere. Good vibes and momentum can take it higher than you can expect. On the other hand, I'm concerned about getting this question, and it's not just one question, it's a few questions of different flavors, but along those lines. And getting that question after we've seen massive greed and euphoria, key psychological top signals, technical signs that you only see at market tops, long-term holders distributing, taking profits, a spike in mergers, a drop in fundraising, key divergences on several dimensions. These are all things you see late in a market cycle. And even the bulls agree. They just think we're going to get this banana zone, alt season, blow off top, rush of liquidity, FOMO, everything goes supernova. But either way, they think we're almost at the end too. So look, if Bitcoin's price hits $113,000, that's a new all-time high. So the cycle continues. But is that really substantively different than the $109,000 we got earlier this year, or the $112,000 we got earlier this year? I mean, for an asset that goes up or down 10% in a week, 1 out of every 4 weeks in a year, 25% of the time, you're going to wake up in a 1 week period and see the price move more than 10%. So I would chalk that up to natural volatility, 113, 112, 109, 118. It's essentially the same. There's no reason to get worked up over a few $1,000s. 10% here, 10% there. I mean, it's the same. I'm not worried about the probability of a top. I'm more worried about missing the drop to $50,000 or not having enough cash to buy when Bitcoin's price goes below $70,000. So today, you're playing for, I don't know, maybe 50% upside, maybe less. And that assumes you get your timing perfect, which you won't. And if you miss the top, you might get stuck. Because what if the market keeps dipping? What if then November comes and you say, well, it's just a natural drop. We got this in 2017. It dropped and then we exploded at the end of December. So you stick around. The market has to peak in December. It's just another drop. It's just, we've seen, how many times have we seen this before? We did this all the time. And you brush it off. And then pretty soon the market crashes before you can sell. Everything looks fine until it doesn't, so just keep that in mind. So Mark, why do you say you need to de-risk because you live in the U.S.? The U.S. faces economic headwinds. The stock market is frothy with high valuations. The new administration wants to grow government debt and shrink government spending. That's what they're doing. So you have this, this larger move to unwind the key drivers of the U.S. economy for the past 5 years. Doesn't mean that the past 5 years of growth was built on a sturdy foundation. It just means they're changing it. They're changing the way that the economy, the dynamics of the economy, right? You got tariffs, you got deportations. Those hurt a lot of businesses. You never know how much others can pick up the slack. Core inflation remains stubbornly above the Fed's benchmarks. Our high debt burden makes it hard for the Fed to cut rates. Other austerity measures drag on the U.S. economy. It's not public like it was before at the beginning of the year, but it's happening. It's not urgent like it was before and targeted and big and sudden. It's just slow. Some people call it death by a thousand cuts. I don't know. I don't know if that's an accurate um, description. Time will tell whether this transition puts the U.S. in a better position. I hope it does. I don't think the transition will be as easy as people expect. And as a resident of the U.S., I need to consider my job security. I need to consider my cash flow. Markets always adjust. Economies adjust. Even in recessions, more than 90% of people have jobs who want jobs. The U.S. has a lot of people working in service industries and side gigs, so it's very flexible, it's dynamic, it's resilient. I want to have ample capital to take advantage of opportunities that come when the froth dies down. Other countries, it's different circumstances, so you have to make a different plan. But that's how it is in the U.S. Mark, will the stock market crash? I don't know. Stock market, totally different beast. I do crypto. The U.S. stock market benefits from circular capital flows. Money goes in, money comes out. Money goes in, money comes out. There are subsidies for workers and businesses who put money into it. A lot of sophisticated financial engineering to keep these companies profitable, and it's a magnet for foreign capital. And if it gets bad, the U.S. government will step in. So even though the stock markets, a lot of these stocks trade at bizarre valuations, the businesses generate revenue, they distribute benefits to shareholders with dividends, buybacks. And so at the end of the day, you have real entities with real products and services that people want to buy, generating real profits that can get recycled. Crypto has none of that. So you just have to consider, like, okay, when crypto goes down, that's it. When the stock market goes down, there's always a redeeming value. And at some point, you won't be able to say that about crypto. You will say, well, it goes down, but there's real traction, there's real world benefits that keep people coming in and keep people coming back and keep people putting money in. Crypto doesn't have that yet. Is this the last question? I think this is the last question. Does your analysis change now that the macro has changed? I got a few flavors of this. That is specifically a question I got, but then a few other flavors of that. And I don't see the macro has changed. So people talk about this measure of liquidity. It's called M2. It's the raw money supply. It's one measure of liquidity. It's one of many. And it's gone up. So people say, okay, the macro has improved, right? We're not talking about tariffs anymore. The U.S. stock market has recovered, and unemployment is good. But it's been that way for a long time. That's how it was earlier this year. The macro hasn't changed. And the one thing I would say about this whole liquidity M2 thing is it's gone up, but that some of that is just a function of how the metric is designed. It doesn't necessarily mean actual liquidity has gone up because the metric is priced in dollars. It measures liquidity in dollars. So when the dollar goes down, as it has done for a lot of this year, even if liquidity doesn't change, the metric goes up. And you can think about it this way. So there's the dollar, and then there's liquidity. And so now it's even on whatever day you're looking at. Like you look at it today, and there it is, they're even. The US dollar goes down, keeps going down. To you, liquidity goes up. It looks like liquidity goes up because liquidity is now higher. So the M2 goes up, but only because it's being priced in dollars. The dollar went down, but liquidity didn't move at all. That liquidity hand hasn't moved one bit. The dollar has gone down. So when you price things in dollars, like that liquidity metric, it goes up. Liquidity is a lot more than that. I mean, it's kind of nebulous in the sense that there are lots of different measures, and it may actually be changing. It may be changing. It may be going up. I'm just saying that you can't say it's going up just because you see M2 go up, because it could be this. It could be the dollar going down. It could also be liquidity going up, or it could be liquidity going down, but the dollar going down faster. And all sorts of other things. It just makes it more muddied. And since there are so many different measures of liquidity, I mean, I don't really know. Like I'm not. I just would take it under advisement, recognize what's going on, and just kind of plan accordingly. Japan, Europe, and China, they provide a lot of liquidity too, and each of them have their own problems. They have unique problems that I can't handicap this. I don't have that expertise. But look, Japan has a really difficult situation. It can't manage its currency and the rate of inflation. And it'll hopefully find something, some way out. But that's its challenge right now. Come back in 2 months, maybe not. China, it's been trying to get out of this rut for years. It hasn't found a solution yet. Could change in 2 months, but now, as of this video, that's what it is. Europe seems to be doing okay. They're cutting rates. I guess the economy is growing, but how long is that going to stay up? I don't know. I don't know. So all these things. So I mean, it's just one thing. You take it under advisement and make the best decisions you can. I'm more focused on crypto and what's going on with crypto. So yeah, the macro matters. It does matter. Everything matters. But I don't change it based on macro, especially when the macro hasn't changed. I hope that was helpful. And if you have any other questions, look, you can always reach out to me, mark@markhelfman.com. Comment on any of my posts and relax and enjoy the ride.